Welcome to another episode of Retirement Police Most Wanted. Today, March Madness. Once again, we are talking bracketology. You think we're talking basketball? Maybe. But really, we're talking about those tax brackets and how you're going to manipulate them so you can break the golden handcuffs and escape the retirement police. You don't have to worry about the sirens when they're coming after you, 'cause you are well hidden, and so will your assets be. We'll talk more today on this episode. My fellow FIers, welcome back to another exciting episode of Retirement Police Most Wanted. More March Madness, more bracketology. And today we are thinking about this more, our bracketology from longer term. Our last episode, episode 9, we talked bracketology in terms of thinking about the Tax Cut and Jobs Act that Congress is debating, the 2017 Tax Cut and Jobs Act. Those tax cuts and those tax brackets expire at the end of 2025. If Congress does not act, I think it's going to take almost the entire year for them to really sort this out. If you want my HouFIni crystal ball magic prediction. But in the meantime, just thinking about whether or not those tax brackets expire, and right now the brackets are 10%, 12%, 22%, 24%, 32%, 35%, and then the top level is 37%. And prior to the Tax Cut and Jobs Act of 2017, your lowest bracket was a 10% bracket, but then it jumped up to 15% bracket instead of that 12%. From 15%, you had a 25% bracket, which again is higher than the 22% bracket today. Then you had on top of the 25% bracket, you had a 28% bracket. Again, we're talking higher than the 24% bracket, which is the next bracket today. And in 2017, your fifth highest bracket was 33%, slightly above the fifth highest bracket of 32% today. The next bracket was 35%, which is the same. Where that bracket falls in terms of income, major difference there. And then the highest tax bracket previously was 39.6% instead of the highest level being 37% today. So if Congress doesn't act, I mean, it's essentially almost an automatic tax increase for pretty much every single American. So in terms of your bracketology, you really want to keep an eye on this, and you want to weigh in if that is something that you're inclined to do. Thinking about it we do think about this on a yearly basis, and I would encourage you to go back and listen to episode 9 where we really get into the details. But from a longer term perspective, whether Congress extends these or not, our goal is to do things in the future such that we will really be in the lowest tax bracket possible, so that taxes do not absorb a huge chunk of our income when we are on the lam from the retirement police and are on their most wanted list. One of the strategies, and we have certainly discussed before, and we know this is unique, and we're not saying this is everybody, but for us, we have a two-part strategy, a two-part FI number. And if you want to learn more about that, go back to episode 3, where we give very detailed explanation of our two-part FI number. And then episode 4, we also give an update on where we are in that two-part FI number process based on where we were at 99 months away from our paid work optional escape. We're now 98 months away from our paid optional escape. Briefly, our two-part strategy in the part 1 FI number, age 59 and a half to age 65, we have multiple cash-like investments. We do have some other investments in there as well. But our goal really is to have like 3 years. Ideally, we would have 3 years of retirement income in cash. So think of like CDs or high yield savings accounts or money market accounts. And we'd have that money safe, and that would already be after tax. And then obviously whatever we make on it is slightly taxed, but our assumption for our part 1 money is that we wouldn't be generating any earnings. So there's a little bit of a built-in falsity in there to some degree. Things like after-tax Roth IRA funds are also part of that part 1 FI money. And so we would think about bucket of cash in an ideal world would be $150,000. So let's say we could live on $50,000 a year, and we would need to continue to be able to manipulate things such that we were in having $50,000 a year that we could keep manipulating. As of today, needing $50,000 a year as a married filing jointly couple, we would be in the 12% tax bracket. And that's really doing already in the second lowest tax bracket. Past the tax cuts, it would be the 15% tax bracket in all likelihood. We wouldn't no longer have income per se, so we could, where we were from an employer, and therefore we wouldn't be able to contribute to 401k or 403b or thrift savings program or something like that. We would have the standard deduction. So as of today, the standard deduction is $30,000. Let's say we were very comfortable and used to being taxed on that $50,000 worth of income. Well, what we could do essentially, and again, all these things are personal. This is a disclaimer. This is not investment advice. This is for entertainment only. You and your spouse, your family, you should be consulting with your tax professional, your legal professionals, all of your financial advisors, your religious advisors, your life coach, any of the people that you seek expertise to put together your life strategies, including your financial strategies. You should be going to see those people. Let's say in our situation, we were comfortable with being taxed on $50,000 after our various adjustments. Well, the normal standard deduction is $30,000, and if we pulled $50,000 or had that converted from a regular 401k, and we wanted to shift that to a Roth 401k and roll that over, our standard deduction would be $30,000, and so we would have $20,000 in taxes on that. If we want to completely maximize it, we could actually roll over the $80,000 and have the $30,000 standard deduction, therefore being taxed on essentially the $50,000 after our standard deduction. So we could live off of, let's call it that cash bucket, where we intend to have 3 years of income. We could be living off of our $50,000 and converting the other money. Now, the thing about it is, we're assuming no investments, but you do have to, when you're doing your bracketology, you do also have to factor in, let's say we're simplify this example, and let's say we are doing $100,000 a year is what we want to live on a year. Again, this is just for simplification, not saying that this is what we do. So we have 3 years worth of money in our cash-like instruments as part of our Part 1 FI number, not our total, because for us, we have 5.5 years worth of income. That's our goal in investments that are not as high risk, so that we can really use that 5.5 years to know, okay, solidly, we've got this money. We can live during this period. We figure it's going to be more very go-go time period. That's our hope and prayer there. And we know we want to not have to think about or worry about whether or not there's ups or downs in the market, or whether or not we're going to have this funding. So let's say our example is $100,000, and we have a bucket of money that is 3 years worth. So we have $300,000 that is in cash in, let's say, a money market account or laddered CDs. And even right now with interest rates, you could get like 3% interest. So I say all of that to say, let's say you took all $100,000 out, well, the $200,000 sitting there would still generate $6,000 worth of money that you would be taxed on. So as you're factoring these things in, the government is not going to be aware that you're living off of the $100,000, let's say, because it's just in cash. That wouldn't be a triggering tax event. The $6,000 that you generated off of the other $200,000 would be. So you have to think about this. If you're taking money out of pre-tax retirement accounts that you're going to get taxed on to live off of, well, okay, then let's say you're taking $94,000 out of those, converting it over. Normally, as of today in 2025, if you're married, filing jointly, and had $100,000 that you were converting or just purely taking out, again, ask your investment advisors, your accountants, all of that, you would be in the 22% tax bracket. But because of the standard deduction of $30,000, then that would take you from $100,000 down to $70,000, and you would be in the 12% tax bracket. I think one of the other things that is difficult for people in talking to people that are already retired is figuring out, okay, I need $100,000 to live on, but I'm not used to what my taxes are going to be based on that. And so then, I really need to take out more than $100,000 or be able to generate more than $100,000 in order to pay my taxes, which is why bracketology, our March Madness season here, is so important, because there's a major difference between paying and being in that 22% tax bracket and being largely in the 12% tax bracket. Now, I've said this in previous episodes, but not most people, I would say there's some confusion when I talk about taxes with people about what those tax bracket means. So someone will say to me, I'm in the 22% tax bracket, or I'm in the 24% tax bracket. So I married couple filing jointly and we make $250,000 a year and I get taxed 24% of that. You do not get taxed at 24% of that. You get taxed 24% of what is over and above $206,701. That's the 24%. Over and above that dollar amount is where you hit 24%. But if you are at $100,000 a year, and you're married filing jointly, you're in that 22% rate. But because of your standard deduction of $30,000, you actually go down into the 12% tax bracket, which is from $23,851 to $96,950. So very similarly, let's say you're a single person making $50,000 a year, you would be in the 22% tax bracket, but because you're making over $48,476, but by the very nature that you're going to get a $15,000 standard deduction if you're not itemizing, and the vast majority of people are no longer itemizing their taxes, you are down into that 12% tax bracket even before you would put money in. If you have access to an employer pre-tax or post-tax account, you're already in that 12% tax bracket. So you want to make sure that as you're calculating things, you're thinking about it. And so it is really our goal to try and be in that 12% tax bracket, or what would be, if taxes get raised, let's say that 15% tax bracket. We will do as much as we can, because even though your effective tax rate is different, it still cuts into that. So if there's a way that we can truly live below that, somewhere between the $23,851 to the $96,950, that's our goal. Somebody else married filing jointly, maybe they'd want to be below that 22% tax bracket, even though the next bracket is 24%. That is some big fire, as we say, big financial independence, retire early. Make sure, as you're thinking about your HouFIni magic, that you are factoring in your bracketology, your tax bracketology. The other thing, and the mad scientist has talked about this, about the beauty of the health savings account, and the ability to grow your money and the way that the tax laws are written today as of March 2025, you can save your receipts for that and turn those in and reimburse yourself years later. And that's a way to have access to cash that has grown tax-free. So if you are not aware, HSAs, health savings accounts, if you qualify and participate in a qualified high deductible health plan, you can contribute to a health savings account. So the maximum dollar amount for 2025, if you're single, is $4,300, and for a family is $8,550. The beauty also of the HSA is that the money just continues to roll over each year if you don't have any healthcare expenses, versus, as I understand it, the FSA, the flexible spending account, which you don't have to have a high deductible health plan, but that's a use it or lose it situation on an annual basis. At least it was before we participated and had access in a high deductible health plan. So it's pre-tax money, but depending on who your account is with, you can have access to investment vehicles, anything from the money market to some you can be invested in the stock market, and you may want to keep a portion of it readily accessible so that if you do have unforeseen medical expenses that you need to take care of right away and reimburse yourself, you'd have access to those funds. And then maybe you want some funds that are growing, and those grow tax-free, and then you have that advantage of taking that money out later. So let's say it's 2025, I have a health savings account, I max it out, $8,550. It's all pre-tax. So I'm making, let's say, $100,000 a year through my employer. And so that $8,550 for my family, and only one of you then can do this, you or your spouse, that's the family total max, is what I have taken out. So I already have reduced my pre-tax income that way. So it's a beautiful thing. So let's say in 2025, I have $1,000 medical expense, and let's say I wait until 2028. And again, this is under 2025 laws, so I'm going to assume this is still the case in 2028. I could produce that receipt, submit it to my HSA administrator, and say, yeah, I want that $1,000 now. And I could have had that $1,000 from my HSA in, let's just be conservative, and let's just say it was a money market account that was paying 3%. Well, 3% of $1,000, $30 a year, not a ton of money, but I made $90 over that period, and that $90 is tax-free, and now I'm taking the $1,000 out to reimburse myself for that medical expense, and that's not considered income by the government. So it is very much worthwhile to take the time to learn these tricks, these magical tricks that HouFIni and others in the financial independence community are trying to teach you, because the FI in HouFIni is financial independence, and the NI is not an illusion. So these are beautiful things, and we want you to be able to, the bracketology is key, and we want you to be champions. I want you to be a retirement police most wanted champion, and the trophy is your mugshot on the wall of freedom. So with that, we are really, again, thinking about how we can manipulate our bracketology during our part 1 FI numbers from 59 and a half to age 65 to then really help us post age 65 and beyond, that we are essentially putting this money, converting this money, again, assuming these vehicles exist and they exist in 2025, converting that money that was in retirement, pre-tax retirement accounts, and shifting it into being taxed on it when we convert it to Roths, but knowing that after that, there's all the tax-free growth. So the earlier we can kind of manipulate that, and within the bracketology, the better off we think we'll be at the point at which we actually have to make required minimum distributions. So I know you're like, HouFIni, it's March, and March Madness means basketball, and I don't want to think about taxes. You do want to think about taxes. This is how you have 16 seeds upset 1 seeds, your 2 versus 5 matchups. What we're talking about here is game changing. We are talking about how you may be someone who has less earnings, but because you do all the right things, you are able to outperform people with higher earnings, higher rankings than you, just by using the strategies. And part of that is understanding the brackets. So when we're looking at married filing jointly, let me give you another example. Let's say married filing jointly, this couple combined income is $150,000 annually. It's a lot of money. This couple takes the standard deduction for 2025, which is going to be $30,000 for married filing jointly. So right off the bat, their $150,000 becomes $120,000. They are still in the 22% tax bracket at this point in time. But if they max out their 401k, their 403b, their thrift savings plan, and they max that out, which is for someone under 50, $23,000, they're then going to be down to $97,000 when they're doing their taxes. They are just outside of the 12% tax bracket. Now, the top of the 12% tax bracket for married filing jointly in 2025 is $96,950. So they'd only be on the taxed at the 22% level, anything above $96,951. But let's say they're like, hey, I'm going to put the other spouse is going to put $200 in the regular 401k, and it brings them inside that 12% tax bracket because they'd be under $96,950. And the rest they have access to a 401k Roth or 403b Roth through their employer, and they're going to max the rest of that out, $22,800. And so the beauty of that Roth funding, so now they're taxed at a lesser rate and they're getting money in a Roth that's growing tax-free, and they're balancing it out. And you have access to an employer Roth. You could even, one spouse could do, if you're both able to max it out, one spouse is, let's say, doing $13,000 in regular and $10,000 in their Roth, and you're combining to get to it. The reason we're thinking about this now, we're thinking about this early in the year because those tax brackets come out, and you want to be able to manipulate the bracketology such that you are able to maximize your financial situation not only today, but in the future. I tell people in their 20-somethings all the time, I know you're going to, let's say, get out of school or you're going to get a job, and you're going to say, all I care about is what I'm earning. And I say, make sure you look at your benefits package. Make sure you have access to health care, and what does that cost? What sort do you have access to a retirement plan? And people will tell me all the time, I can't afford it. And I say, live like you are still in school. Live well below your means. Don't, because you suddenly get out of school and you have this jump in income and you're like, wow, this is amazing, and do not elevate your lifestyle. Make sure that you are putting money away for your future, living below your means, so that there's still plenty of fun things you can do. There's still plenty of fun that you can have, but it doesn't have to blow the bank. And focus on the experiences that are really meaningful, not just going out all the time, or not just going out and buying a bunch of stuff and not really focusing on it. So this is my first part of bracketology. We hope that you will hit subscribe to Retirement Police Most Wanted. I want you to start thinking about this now. If you're in your 20s, remember, as we said in episode 6, like the heart candy, right? I see you. I see you at all phases and ages of your life. And so we are here to tell you our story, things that we've done, and help you work through it for your own situation. So with that, I hope that you do also get to enjoy some March Madness for real, and stick with us. We're going to keep telling you, keep showing you how to do these magical tricks on your pathway to financial independence. Take care, FIers.